Welcome back to RealPage Economy Express. In this episode, we focus on the most recent data from employment, consumer prices, housing, and the Federal Reserve's monetary policy. Starting with employment, the U.S. Bureau of Labor Statistics reported a significant surge in non-farm payroll employment, increasing by 275,000 in February. This boost in job gains was primarily seen in sectors like healthcare, government, food services, social assistance, and transportation. However, despite this growth, the unemployment rate ticked up slightly to 3.9%, a rise from 3.6% a year earlier. Taking into account the current labor market trends, we have revised our employment forecast for the top 50 metropolitan areas and are pleased to share them with you. As illustrated by the chart, Texas dominates, with half of the markets experiencing significant employment growth. In terms of consumer prices, the Consumer Price Index rose by 0.4% in February, with annual inflation at 3.2%. Notably, shelter and gasoline prices contributed significantly to this increase. However, given the 12-month lag between shelter inflation and market trends, inflation is expected to decrease further in the upcoming months, aligning more closely with the Fed's expectations. Turning to the housing market, we observed an uptick in residential construction activity. Building permits rose by 1.9% from January to February, with a year-over-year increase of 2.4%. Similarly, housing starts surged by 10.7% month-over-month, suggesting a rebound in construction activity. However, despite these positive developments, mortgage applications fell by 1.6% in the latest week, influenced by higher mortgage rates, which reached almost 7% for 30-year fixed-rate mortgages. In the multifamily sector, our data highlights a substantial number of units still under construction. Here are the top 15 metros with the highest number of apartment units delivered in the first 3 months of 2024. On the monetary policy front, the Federal Reserve maintained its interest rate range between 5.25% and 5.5%, signaling a cautious approach despite planning 0.75 percentage point cuts by the end of the year. Now, this decision reflects the Fed's strategy to balance strong job growth against the need for sustainable inflation control. These recent trends indicate that the U.S. economy is undergoing dynamic changes characterized by strong employment growth, ongoing inflation pressures, and a housing market demonstrating tempered optimism. However, the mixed signals from the labor market and the Fed's cautious stance underscore the complexities of achieving a balanced economic recovery. Stay tuned for our next update in 2 weeks. Thank you for joining today's session on RealPage Economy Express.